Major Asia-Pacific reinsurance companies saw their insurance revenue grow markedly under IFRS 17 in 2023, supported by a more stable investment environment and less catastrophe activity. Here to discuss a report on the region's reinsurance market, part of AM Best's annual look at the global reinsurance industry, is Chris Lim, Associate Director of Analytics, and Christie Lee, Senior Director, Head of Analytics, respectively, from AM Best Singapore and Hong Kong offices. And Christie, let's start with you. How did the performance of the major reinsurers compare with that of the global market in 2023?
Hi, John. In the Asia-Pacific reinsurance composites, which include major IFRS 17 reporting reinsurers, we saw the insurance revenue growth was up by 8.8%. This growth was partly driven by China Re's international business expansion through Chaucer and also favorable market conditions. Additionally, the net combined ratio, as measured by AM Best, improved significantly from 94.5% in 2022 to 91.6% in 2023. The reported ROE also saw a substantial increase from 0.1% to 9.2%. These positive results were largely due to low cat activities, a high interest rate environment, and also favorable investment returns, with the exception of China. However, it's important to note that the magnitude of ROE improvement for major Asian reinsurers might not be very significant as compared to some of the global peers. This is because Asian reinsurers typically they have a large book of proportional treaties in traditional lines, which are less directly impacted by the rate hardening market conditions. Despite this, our view is that the overall stability of the Asian reinsurers underwriting return over the long term is very remarkable. So this is my view from North Asia perspective. And now I will hand over to my colleague, Chris Lim, to share his observations on Southeast Asia reinsurers.
Thanks, Christie. So reinsurers based in Singapore, South and Southeast Asia reported favorable earnings in 2023, supported by strong investment returns as well as robust underwriting results. Reinsurers reported healthy interest income from fixed income instruments in 2023 amid elevated interest rates, supported by the global monetary policy tightening, where interest rates climbed steeply from mid-2022 to early 2023 and stayed there. Underwriting results also improved, benefiting from lower insured cat losses, underwriting discipline, and a more favorable pricing environment. Like the global reinsurance players, Singapore domiciled reinsurers generated solid underwriting margins for a third consecutive year in 2023. In particular, underwriting profits for the reinsurers offshore insurance fund increased to 1.1 billion Singapore dollars in 2023, which was 23% higher than the year before. Property reinsurance, which accounted for more than half of total gross premiums of the reinsurers OIF, saw the biggest improvement, with the loss ratio declining by approximately 10 percentage points.
Christie, as IFRS 17 has become more widely adopted, how is that affecting your view of Asia-Pacific reinsurers?
Most major Asian reinsurers in North Asia have adopted IFRS 17 in 2023, except Taiwan, Japan, and also China non-listed companies. We see IFRS 17 primarily as an accounting standard change, which doesn't alter the fundamental creditworthiness of reinsurers. However, it does significantly change how financials are presented. So users need to understand the characteristic of IFRS 17 and why financial metrics have changed. Specifically, in the Asia-Pacific reinsurance composite, the gross premium written is no longer a mandatory disclosure item. Instead, insurance service revenue replaces premium written as the revenue line, and the components of the insurance service revenue differ from GPW. So I have to say that direct comparisons are not very appropriate. The reduction from GPW to insurance service revenue is relatively larger for Asian non-life reinsurers. This is due to their larger book of proportional treaties, and also under IFRS 17, part of the reinsurance commissions of these proportional treaties offset insurance revenue, making the revenue reduction appear larger compared to their international peers who are more focusing on the excess of loss. Despite this, Asian reinsurers' premium growth remains strong and healthy. Regarding key operating performance metrics like combined ratio and ROE, these metrics have the same names, but they are composed differently under IFRS 17. Insurance liabilities are now discounted, partially offset by an explicit risk margin, which has an overall effect of lower combined ratio. And management expenses classification has also changed. Commissions are not allocated consistently as in IFRS 4. So separate analysis of loss ratio and expense ratio is losing relevance, and now with greater reliance on the combined ratio and ROE. As both the numerator and denominator have changed from the combined ratio, we generally observe reductions in the combined ratio for reinsurers. For example, the 2022 net combined ratio of the Asia-Pacific Reinsurance Composite, calculated by AM Best, moved from 100.2% under IFRS 4 in 2022 to 93.4% under IFRS 17. The magnitude of combined ratio reduction impact is greater for reinsurers than in the direct market. So I think the key message that I've here is it's very difficult to compare metrics under IFRS 4 and 17 and making direct comparisons between reinsurers with different accounting standard more difficult. Now, I would like to invite my colleague Chris to see anything he would like to add.
Thanks, Christie. The transition to IFRS 17 brings greater transparency to insurance accounting and also more complexity, but it is not viewed to have a direct impact on companies' ratings. There is some impact on transition in relation to reported shareholders' equity and profits, but the impact is generally less material for non-life reinsurers as compared to their life counterparts. The economic view of the company's underlying business remain unchanged, but given that there are both IFRS 17 and non-IFRS 17 reporters in this region, performance comparisons and benchmarking for these companies will then require very careful analysis.
Looking regionally, Christie, what trends are you seeing in North Asia?
North Asia is also a large and diverse market. And so let me share some of my observations in terms of trends in two of the largest markets, Japan and China. In Japan, the wind excess of loss program has seen more than a double rate increase since 2018. So coupled with the improving operating performance that we observe in global reinsurers, in past April renewal, we saw a noticeable increase in reinsurers' appetites coming back to the catastrophe risk. This signals a turning point for Japan's cat capacity supply and demand. And in China, throughout 2024, we have observed relatively less pressure in filling the capacity compared to 2023, as well as in some other markets. It's quite unique that capacity needs perhaps a more easily found and met by strong support from onshore reinsurers and primary insurers who also write inward treaty books. And they actually provide a very stable capacity for the non-life segment in China.
Chris, how about in South and Southeast Asia?
Within this region, reinsurance renewals in January 2024 and throughout the first half of the year have generally been more orderly than in 2023, and this aligns well with prevailing market expectations. Following the rate hikes and tightening underwriting discipline the year before, market conditions have stabilized. Rates in most markets flattened, with improvements in either direction largely range bound in the low single digits. Rate movements were stable. The reinsurance structures were stable with few material changes. And although the appetite for property cat reinsurance has grown, Optimism has returned to the lower layers in the region in 2024, driven by reinsurers' growing confidence in current pricing levels. In some markets, there were oversubscriptions for reinsurance treaty placements, and this experience contrasted sharply with the experience 1 year ago, when it was a challenge for some players to fully place the programs. And despite the reinsurers' greater willingness to deploy capacity, this has not yet reverted to a buyer's market just yet. Reinsurers are also incorporating strict terms and conditions to limit their risk in the event of treaty underperformance. Apart from lowering commissions, reinsurers are continuing to impose sliding scale commissions, loss participation clauses, and in some instances, other minimum conditions for property reinsurance treaties during the 2024 renewals to ensure pricing adequacy for the risk borne. Not only have reinsurers taken actions to improve the quality of inward business, they have also strengthened their underwriting discipline and accumulation management to support cost-effective retrocession purchase. Some of them have also adopted the use of multi-year agreements and named peril coverages to manage their retrocession costs.
Thank you, Chris and Christie.
Thank you, John.
Thank you, John.
That was Chris Lim, Associate Director Analytics, and Christie Lee, Senior Director. You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.